Richard?
Oh, ready to start?
Yeah, I think we're ready to start. Right, so welcome to session 18 on the macroeconomic effects of macroprudential policy. We have three papers today, and that are going to be discussed by three persons. The setting is that we have 20 minutes for presentation, 10 minutes for discussion, and then 10 minutes for Q&As. And I guess you can also directly, of course, ask questions to the presenter as well. During the Q&A, I suggest that you can raise your hand or send a message to me, and I'll give you the floor to ask the question. Okay, so I guess we can start with our first presenter, was Anton Korinek. He's going to present the paper Macroprudential Taxes, Ratios, and Rents, Equivalence and Not Quite Equivalence. Anton, the floor is yours, and look forward to your talk.
Thank you very much for hosting our session and for including this paper in today's conference. So this is joint work with Daniel Harper, who is also at the University of Virginia, and who will in fact be alternating with me as a presenter. But let me start it off. So what this paper is about is the following. Since the global financial crisis over the past dozen years or so, we have seen a whole plethora of macroprudential policy measures. There have been lots of different measures proposed in theory papers, implemented in practice, and also evaluated in empirical papers. But there has been less of a focus on the precise distinctions between the different measures proposed. That was considered as part of the kind of plumbing of the regulatory system, which in our view has received kind of insufficient attention. So the focus of this paper is how do similar types of macroprudential measures differ from each other, or when are they in fact equivalent? I believe some of the most important results in economics are equivalence results. Of course, they never hold precisely in practice, but they give us a very important kind of benchmark to think about. And then as we continued to work on this project, we realized that one of the main distinctions of many different measures is that they have differential effects on the distribution of wealth. And that's also one of the prime focus points in our paper. So what we are going to do in terms of methodology, we will first start out with a very simple analytic borrower-lender framework where there are externalities that motivate macroprudential regulation. We will work out equivalence conditions, first just for traditional price and quantity measures, kind of in the spirit of Weizmann, but then we will also develop a novel analytic tool to expand those results to ratios, because we know that in practice, a great deal of financial regulation takes the form of ratios. We will emphasize the effects of these different types of regulation, not only on efficiency itself, but also on the distribution of income. And finally, and we will see that in some sense, all the insights from the borrower-lender model carry through in that setup. We will generalize the results to a triple-decker model of finance where there are essentially borrowers, banks, and lenders. So to just give a preview of our key results, We will show first that the traditional duality for price and quantity measures holds. It's not super surprising, but that there are important distributional effects that are often neglected. Price regulation would theoretically allow policymakers to determine the distribution of surplus. So if we had something like macroprudential taxes, there's an explicit revenue generated, and that makes it very explicit who will receive that revenue. On the other hand, quantity regulations and later on also ratios implicitly assign the surplus to the agent who is subject to the regulation. We then develop an analytic tool, we call it a transformation of measure, to extend our results to macroprudential ratios. We show the conditions, the specific technical conditions under which they work, like quantity regulations, but now on heterogeneous agents of different size. And we will also look at the effects of ratios that are contingent on endogenous variables. We will show how and why they distort certain choice variables. And kind of the parting thought with which we will leave you is whether the kind of heavy focus on regulatory ratios is perhaps to some extent because our regulatory system is willing to incur the inefficiencies generated by ratios so that the regulated banking system can keep the surplus emanating from the regulation. So let me also give you a quick overview of the related literature. So there is, of course, lots of works on theoretical justification for macropru. There's a growing body of papers that empirically evaluates, and then there are just very few papers that theoretically compare different types of measures. And our work is basically a contribution to the last one, but perhaps at a level of generality that the papers I am citing here does not encompass. And let me now hand over to Daniel.
So, sorry. It looks like my computer has decided there's an issue with the video camera. So sorry about that. It just had a moment there. But so we start out with a baseline model where we have two agents that are homogeneous within each type of agent in a measure of one. So we have a group of lenders and a group of borrowers who the lenders are endowed with income in the first period, period 0, and borrowers are endowed with income in the second period, period 1. And they have utility, but we distinctly allow them to have different utility so that you can imagine borrowers don't necessarily have to be households, but they could also be things like firms or financial institutions in this baseline model that are borrowing. So they are trading a risk-free debt, which we denote as B, and there's an interest rate associated with that. B is each individual borrower's, or the amount for each individual contract, but in aggregate, which is B bar, it creates this borrowing creates an externality that we simply apply in this reduced form setting, that it reduces the period 1 income. So what borrowers actually in period 1, they get Y1, but then based on aggregate borrowing, this externality takes effect and they lose epsilon B bar of that income. I think, Anton, thank you. So with this, if we want to talk about macroprudential policy, one of the goals there is to get to the Pareto frontier or achieve Pareto efficiency. So we should characterize that out. And Pareto optimal allocations are going to satisfy this condition here that essentially, if you look at just the competitive equilibrium, you get this expression without what's in red. And the externality here, the marginal effect of the externality is red, and that's where the inefficiency is coming in. And in a Pareto optimal allocation, that needs to be priced in somewhere, either on the borrower side or the lender side. That has to be accounted for either through, as we'll show, you can account for that through taxes or quantity limits. And the competitive equilibrium, as I just said, isn't going to be Pareto optimal because it doesn't account for this externality that's printed in red. So what gets us to a Pareto optimal allocation in this setting? We list out 3 macroprudential policies here. We can start with just quantity limits on borrowing or lending, which are just strict. This is the not ratios, which is strict quantity limits on this is the maximum that can be borrowed or lent. There can be taxes applied that, if you look at this expression here on the taxes, that essentially the taxes are pricing in the externality, and you can apply them on both borrowers or lenders. And then the government gets to transfer the tax revenue out to borrowers and lenders as it sees fit, subject to its budget constraint. Or you can have a combination of the two, as is described in the third point here. But to kind of see these better, we have a few graphs to illustrate this out. So we start with looking at the competitive equilibrium, and we have this purple line here that shows the supply curve which is coming from lenders' preferences, and then the blue line shows the privately optimal demand curve coming from borrowers. And then the green line is the socially optimal demand curve, which is the demand curve that the social planner would want borrowers to have once the externality is accounted for. And you can see that there is a difference between the 2 different quantities, and there's this deadweight loss that's produced where when overborrowing occurs, there's a social loss that gets incurred. So our policy is going to want to, within this graph, shift these curves around to avoid that. A simple policy to start off thinking about is just Pigouvian taxes on borrowing. So here we have only taxes on borrowing, and by taxing borrowers and then rebating the revenue of that tax back to borrowers, we're able to shift the demand curve to the socially optimal demand curve and implement the socially optimal allocation. You can also imagine here that taxes could go on either set and get there just different ways. Now, quantity limits you can apply a quantity limit both on borrowers and on lenders. And when you do that, what happens if you're applying the quantity limit on lenders, then the interest rate is going to be fairly high because it's an interest rate at which lenders would like to lend out more, but they can't. So now the lenders, since there's this high interest rate, they're getting all of the surplus from the regulation. As you can see here in the graph, the lender surplus really grows here when the quantity limit is applied on lenders. And the other side of that coin is when the quantity limit gets applied to borrowers, the interest rate is going to be relatively low, and borrowers are going to enjoy a surplus because they are getting to pay a lot less interest on what they borrow. So that these graphs show kind of build up to our next result, which is talking about how the surplus is distributed. And I'll hand it back to Anton for that.
Thank you, Daniel. So in general, in such an economy, there isn't just one efficient point, but there's an entire Pareto frontier of efficient points. And whenever we implement some form of regulations, we will either accidentally or intentionally pick a point on that frontier. So what we are showing on this graph is, the typical Pareto frontier, a concave curve. And we are also indicating the competitive equilibrium here by this diamond. And since there are these externalities, obviously the competitive equilibrium is inside the Pareto frontier. And the kind of dashed line here show us the cone of potential Pareto improvements. Now, one of the first really interesting distributive results in our paper is that if we impose quantity regulations on either borrowers or lenders, we will in general not achieve a Pareto improvement, except in kind of 2 knife edge cases. One is the case in which one of the 2 agents has linear utility and then their welfare is constant when we do something to the other one. That's the case that a lot of our banking setups implicitly or explicitly assume. And that means we kind of abstract from these redistributions in a lot of the models that we employ, just by the force of assumptions of simplification, like having linear lenders. The other possibility, and it's again kind of a knife edge case, is if the externality generated is very, very large, such that the economy really suffers from this, then imposing a quantity limit on lending can actually generate a Pareto improvement, because the lenders get so much less of an externality that they suffer from, and the borrowers can get all the surplus. Now, if we do employ, and one more thing on the quantity limits, similar results will hold later on for the regulatory ratios. If we employ macroprudential taxes, then we have a tax revenue, and we can define conditions such that there will be a Pareto improvement. Generally speaking, we will have to split the surplus between the two sets of agents in order to get a Pareto improvement. If we give it only to one of the two, then it would not be a Pareto improvement. Then it would be, again, like in case one here, on the proposition that one of the agents is better off and the other one is worse off, even though overall efficiency in the economy has gone up. So now the next thing, as I promised, is that we extend this setting to ratios. Why do we have ratios in the real world as opposed to price and quantity controls? Well, ratios as opposed to quantity controls, I think one of the main reasons is that regulators want to apply non-discriminatory measures, but regulated entities differ in size. So that means obviously uniform quantity controls cannot possibly work. And regulators resort to ratios kind of as a substitute for these quantity controls when agents differ in size. So the intuition behind ratios is, if regulated entities exhibit same characteristics, let's say there is a smaller bank and a larger bank, then they are all kind of scaled up or scaled down versions of some sort of representative borrower or lender. And as we scale up or down our quantity controls together with the size of the agent, that would be something that looks like a regulatory ratio. So what we show analytically is that if we are in this type of situation where all agents are scaled versions of each other, it is analytically equivalent to treat the entities under consideration as entities of identical measure but different size, or as entities of different measure but identical size. And if we transform from one of these measures to the other, then we can simply extend all our equivalence results to agents of heterogeneous size who are subject to regulatory ratios. And that's what we do analytically. So one important condition, and we make that very transparent in the paper, is the scaling requires that agents are at some level homogeneous of degree 1. So it means their utility needs to be homothetic, or if they have production functions, they would have to be constant returns to scale. And then we show the following lemma, and that's kind of one of the most important conceptual results of the paper. If we have these lenders of heterogeneous size, let's say we label them by different size of initial endowments, they can equivalently be represented by lenders of equal size under a size-weighted measure. And we can do the same thing for borrowers. And then we can analyze all these heterogeneous borrowers and lenders like a representative lender of borrower or borrower, and we can impose our macroprudential quantity controls on them, which, given that these are scale agents, now suddenly translate into ratios. So one proposition on this, if borrowers differ in their size and their utility is homothetic, then we can achieve these efficient allocations either by a macroprudential tax, a debt to size ratio on borrowers, and lending to size ratios on lenders. And of course, if we had a constant quantity limit, this would not implement a Pareto optimal allocation anymore in this type of setting. Should also emphasize that the redistributive results that we looked at in our previous setting carry over 1-for-1. So again, ratios imposed on borrowers keep the surplus with borrowers, ratios imposed on lenders keep the surplus with lenders. And now let me hand over to Daniel.
So after we've done this with size, that this is actually the size and endowment economies that we've been working with are something you can't really see someone's size in practice, which is what our endowments are representing. What's much easier to observe in practice is endogenous variables, things like asset holdings or earned income. So we extend our model where on the borrower side, borrowers are able to hold assets and earn income. And the way we do that is we have borrowers that are able to create these assets in period 0, and they have cost of producing assets, G of A, and the assets are going to pay off in period 1. And the cost of producing assets is increasing as assets increase, as the number of assets increases. And they also are able to exert an effort, E, to generate more income. So, and there's a disutility associated with exerting this effort. You could think of this in this context of households as things like going out and providing labor in a job, or you can think about this effort as like rent-seeking behavior on behalf of firms. And there's an income W that's earned per unit of effort exerted. And we now kind of move borrowers' utility to be a little more generalized of their consumption in the 2 periods and their effort, and utilities decreasing in effort as effort increases. So in this endogenous variables framework, we then want to think about macroprudential policies that, particularly macroprudential policies that are based on these endogenous values. So if utilities homothetic, we're holding to that still from earlier, then a debt to size ratio, like what we were talking about earlier. So the ratio based on endowments can still implement a allocation on the Pareto frontier, but also a loan to value ratio or a loan to income ratio when it's combined with a tax on either asset creation or exerting effort is capable of implementing a Pareto efficient allocation. But it's important that the tax is also there. And to illustrate that, we have the Euler equations for asset accumulation and exerting effort. And you see in red here that when there is a loan to value or loan to income ratio, there's this added effect in the Euler equation that's kind of a collateral value type effect, at least for assets, and a similar effect on income, where now holding an asset both gives you a value based on the discounted value of the dividend, but it also has a value because you're able to borrow more money when you have more assets. And that's going to give you an incentive to produce more assets, or similarly, it's going to give you an incentive to work more. However, you'll notice these taxes are in here. The tax is able to correctly sized. If you correctly size the tax, then you're going to be able to offset this effect and get this Euler equation back to where assets or income are just valued at their discounted present value. So with that, we have our next little corollary to our earlier proposition that if you have a loan to value ratio or a loan to income ratio alone, you're not going to get a Pareto efficient allocation. And I think we're out of time, so I'll hand it back to Anton for a quick concluding remarks.
Okay, let me perhaps quickly highlight a few additional equivalence results. Macroprudential policy is also equivalent to actually financial constraints imposed by the market if they are of the right type, or by restrictions on quantities that are created by market power. So that really shows us how there is this important blend of rent generation from financial regulation. And as I mentioned, in a triple-decker model, many of the same results apply, and notably ratios on the financial intermediaries, as we observe them so much in practice, benefit the intermediaries by keeping the surplus there. And now let me just conclude. What this paper does is we show equivalence conditions for different macroprudential measures. We develop a transformation of measure approach to expand these results to ratios. And we show that even though many different measures can all bring us to the Pareto frontier, the type of regulation affects how the surplus is distributed. And generally speaking, macroprudential measures do not necessarily create Pareto improvements. And finally, our results and ratios, when they're based on endogenous variables, we know that they distort choices. But what our results suggest is that maybe our current regulatory framework is willing to incur that inefficiency to allocate the surplus to regulated entities. Thank you.
Thank you, Anton, and thank you, Daniel. So the paper will be discussed by Josef Schroth from Bank of Canada. So Joe.
Oh, thank you.
Yeah.
So I start this, okay. Can you see the slides? Okay, perfect. All right, so I'm very happy to discuss this very interesting paper by Daniel and Anton. So the paper is about taxing or rationing intermediary activity. The motivation is that the financial system gives rise to macro externalities. They work through various markets. General equilibrium effects matter here. That's important to regulate because of possible nonlinear effects. So here the global financial crisis was like a wake-up call. We saw that the financial system can contribute to severe economic recessions, and most jurisdictions now try to follow the guidance of Basel III. But where do these policy implications come from? What we want to do is we want to make the financial system safer for the macroeconomy, avoid these spillovers from finance to the real side. So basically what we want to do is we want to better align the private and the social margins. And that makes it very natural, especially for researchers, to formulate policy implications in terms of corrective taxation. So we want to put a wedge in there to make the allocation optimal. But in practice, as Anton said, policy tools are often in terms of constraints or ratios. So we need to understand how they relate. Are they equivalent, or are we missing something important? And that's exactly what the paper is doing. So they start out with a generic externality. So think about some borrower future consumption penalty that's increasing in convex in the loan size. So that's basically capturing the classic problem of borrowers getting into trouble because they borrow too much. So they show that it's possible to restore Pareto efficiency with a range of tools. You could have corrective taxes or quantity limits on either borrowing or lending. Different combinations can yield a Pareto optimum, but they are very different distributional implications. Agents facing the limit may get better terms, and others can be worse off depending on who's paying the externality penalty. And of course, it also matters who receives any tax revenue. So we need to be careful about the design of macroprudential policy. In particular, we can end up having a Pareto optimum without having a Pareto improvement as a result of our policies. We might even end up with policies that make problems of inequality worse. So this paper, and that's it, because of that, the paper is a very important contribution to a very important question. Let me just give a couple of comments. So the first comment, I think the externality is not 100% generic in a macro sense. It depends on financial flows. It's not a super detailed real side. I understand the strength of the model is supposed to be general, so obviously it's not a big model. But I think just as an example, you could consider labor income coming from capital investment. Maybe the story could change if savers are also workers. Borrowers might enjoy some limited liability, then the externality might potentially be borne by lenders in that case. So I think it's important to structurally understand where the externality bites most, and then we can design policies that guarantee a Pareto improvement. Again, I understand, the goal here is not to build a huge model, but maybe some additional explanation in the paper about why the externality that you chose is the relevant one and captures the important cases, and whether these labels borrower lender are interchangeable, and just a bit of discussion in that sense would be helpful. I think it's also probably good to talk a bit more about what makes this so macroprudential, right? I mean, we know there's a lot about a big literature, obviously, on discussions about externalities when there's inequality. The paper you cite Weizmann, I mean, they have that paper has a lot of citations, so there might be stuff in there that's already useful. Big literature on taxes, redistribution, and externalities. Maybe some results can be applied to macroprudential. So I think it's useful to make clear what's so special about financial markets, given that the model is general, and I mean, I do believe that there's something special about financial markets. I just think that the case has to be made in the paper, given the generality of the model. So what's special about financial markets relative to other markets? In these markets, you might also see corrective taxes or quantity limits. You might also see distributional effects being a concern in these markets. I got the impression that maybe not all revenue from corrective taxes is rebated to the taxed agent. So I was wondering, why not stop at taxes on lending? And so why would you stop at taxes on lending and borrowing? In that sense, the timing and the possibility of transfers might be important. Can we give the tax revenue to the borrower in the first period? That might actually reduce their need to borrow. We could even go as far as imposing a wealth tax and give it to the poor and entrepreneurs. This might actually achieve Pareto. This might achieve financial stability because we're not needing any borrowing anymore. And of course, it's prerogative, but I think we might even increase taxation and transfers to drive the externality to zero. So just some motivation for why that's a financial market, and again, a bit in that direction. I think it's useful to think about who these borrowers and lenders are. The model is not super descriptive in that direction. You could think about examples where there's borrowing against the liquid wealth to finance consumption. You could think about lending to firms that also pay the wage and the pension of the lender. You could think about tightening LTV constraints on mortgage holders. What homeowners then have to compensate banks. Should we tax mortgages and give the revenue to banks? Or in practice, we see borrowing subsidies, or maybe mortgage subsidies. Maybe there's a relationship to that could be discussed as well. So I think for studying redistribution, it's really crucial how we model heterogeneity. You could even go as far as setting up like a little Ayagawi type model where households borrowing and lend. They might own the firms that they lend to as well, and those firms might be paying dividend and wages to households. And those firms could face a fire sale externality as a Lorenzoni. I mean, again, I understand that's not the model you're going for because you're going for something general. But it might be useful to speculate, if results would change if the problem is considered in such a structurally more fleshed out environment. So just a bunch of random comments. So I think Anton, he has a nice paper, a nice recent paper where he's looking at ex ante and ex post policies. Again, I think it would be nice to see how the results, how these redistributional effects would look like if you have both ex ante and ex post considerations. So I think the prescriptions might also depend on where you are in the financial cycle. The externality function could be a function of the state of the economy, not just of the borrowing flow itself. Its sign could even change depending on the position of the financial cycle. We know in practice that countercyclical policy may lean against credit or support credit, depending on where you are in the financial cycle. I mean, going back to this kind of Ayagawi type model, I think the structure of the economy could also imply a weighting scheme. So if, for example, ex ante all agents could be identical, you could have then afterwards stochastic transitions. then you could just maximize their ex-ante expected utility. That you would basically get rid of all the of some of the degrees of freedom. So let me conclude. So the paper offers a very clean analysis and produces some very important results. When we observe that policymakers implement far-reaching measures, so we really need to make sure that there's no unintended redistribution from these measures. You know, as Anton already suggested, one possible redistributive effect that, you know, maybe toward the financial sector that might not be very appealing. So if we impose macroprudential quantity limits on one agent, we might actually make that agent better off, and we might make others worse off. We might want to know what the general equilibrium repercussions of capital requirements are. We might want to know whether financial market regulations are punishing intermediaries, whether they punish risk takers, or if they are creating costs for someone else. So the paper formulates some very general results for these very important questions. I think I would personally maybe push the authors to be able to focus a bit more on clear-cut policy implications. This might be provocative, but I think it might also stimulate some very useful discussion. Thank you.
Thank you, Joseph. So we just have a couple more minutes before we have to move on to the next speaker, but I think Anton, you may want to reply to some of the comments by the discussant. Then I suggest that the other questions are you take it directly with the authors in the Q&A. Okay.
Let me start by thanking Joseph for the very insightful discussion. He made a lot of suggestions that we are going to implement in future versions of the paper. I'm sure we can't implement all of them because there are far too many. Maybe let me pick up two that I found particularly interesting to discuss. One was the exact nature of the externality and how that interacts with the results. So there are certain to be some interactions if we change the specification of the externality a bit, but I think the overall gist of the result is something that is really quite robust to the setup. So we have been thinking about imposing externalities slightly differently. Now, one other question that I wanted to discuss briefly is, Joseph asked, what is special about the financial markets? So it is very much true that some of these results apply generally whenever we have externalities. But I think what makes it particularly relevant for the financial sector is that ratios are not quite as widespread. The financial sector is probably the market in which regulatory ratios are the most common. And that's why we thought it's really important to kind of clarify this, in particular for the context of financial regulation. And yeah, otherwise, let me thank you again for all the thoughtful comments. And I hope we can ask you for your slides and pick your brain after the public session.
Yes, thank you.
Okay, so thanks a lot again to Anton, Daniel, and Joseph. And let's then move on to the next speaker, and that's Laeven from the ECB. He's going to talk about monetary and macroprudential policy, complementarities, evidence from European credit registers. So Luke, the floor is yours. So you may start.
Thank you, Knut. Can you just confirm that you can hear me?
Yes, we hear you. Thank you.
Okay, so thanks very much for including this work on the program. This is joined with Carlo, a colleague here at the ECB, and Jose Luis, who is affiliated with too many universities to name. The opinions of the presentation are, of course, just our own and don't reflect those of the ECB. I will only briefly motivate the paper, since I think for the audience we are facing today, it's pretty obvious. First of all, as also Anton already introduced, macroprudential regulation has been developed in many places since the 2008 crisis. And this has been done in this context of a more general rethinking of the role of financial stability in monetary policy frameworks. And this is exactly what we will be focusing on. It's about the combination of these two, monetary policy and macroprudential policy. Last year, when we faced this awful shock of the pandemic, was also the first time that these two policies were operating in tandem. And after they had been built up in many years, there was some softening in both policy domains. So that also gives rise to many questions that we can address in our framework that I will present today. This is an empirical paper, and it builds very much on the type of theory that Anton and others have worked on. I just mentioned a few papers here. And in particular, the literature that has considered various trade-offs of using monetary policy and macroprudential policy. However, when thinking about this important topic, it's fair to say that there is, as of today, no systematic evidence of how these two policies interact, and in particular, how the buildup of macroprudential policy and the existence of a macroprudential framework affects the transmission of monetary policy. And it's to this particular question that we hope to provide some insights. In particular, what we do in this paper is ask the question, how does the macroprudential policy environment change the transmission of monetary policy as it affects credit? So the focus in terms of outcome variable here is on credit, not economic growth. But we think that credit, the link between credit fluctuations and economic growth are quite well established. And as we will see in a minute, the reason to focus on credit is that we have an amazing data set available that really allows us to identify this relationship. And in particular, that data set is unique in the sense, in two ways. It is a credit register data set collected for all European countries at the loan level, so individual loans, both to households and to firms, across many European countries. So we have the country dimension that we need because macroprudential policy is set at country level, and we have the European perspective which we need because monetary policy is set at European level. And then importantly, we have a lot of detailed information on all these individual loans, the sectors that these firms operate in, the type of loans, and the conditions attached to that. And in particular, other than the sort of overarching question that we have here, this is the first paper that combines data on both households and firms, which I think also provides some important insights because we can compare the two. And there are many, many excellent papers that focus on, let's say, mortgage loans to households, and then other papers that look at implications of monetary policy on firm borrowing, often coming to quite different conclusions. And this is a data set that allows one to compare the impulse response of one particular policy onto these two different important sectors of the economy. More generally, to just answer this question, and this is probably why we have very little research so far on this question, is you actually do need a variety of credit registers, or at least credit data from multiple countries, because macroprudential policy is not only set at country level, as I explained, but also doesn't change very often. It's not changed every month or quarter like monetary policy may be. So you definitely need some time series data across different countries to identify effects. We contribute to 3 strands of the literature, and I won't have time to go into the details, but basically there is one strand of literature looking at monetary policy and credit, another looking at macroprudential policy and outcome variables like credit. And then we basically combine these 2. And in terms of other papers that consider interactions of monetary and macroprudential policies, we are only aware of 2 other pieces of research that I list here below. But neither of these 2 uses the type of detailed data that we can employ and or considers multiple countries, which we think is important. So a little bit of detail now on the data before I explain to you exactly what we analyze, since this is such unique data. So the European central banks together some years ago launched a massive project where they built up credit register data for their economies covering almost all lending activity across Europe. And the data set that we employ is the one that was collected in the preparatory phase of this project. The project has now come to an end, and so this data is now available for research. The only condition for those of you on the call that are interested to work with this data is that you work with someone from the European system of central banks. This data set has information on 140 million loans by banks that are located in Europe. They don't need to be European banks, to households and firms across Europe. We have the following detailed time and country coverage. The data period is June 2012 until December 2017. The data is collected twice a year, so we have loan amounts outstanding at 6-month intervals. And because of some data requirements we have to also link this to banking data and other variables, and because our focus is on the euro area and not on Europe, because we focus on the ECB's monetary policy interaction with macroprudential policy set in these euro area countries, we come down to using data from 12 countries. And then on the right panel, you see the type of information we have on each individual loan. And I want to emphasize again that we cover both the corporate and the household sector. So just to give you a flavor of how credit evolves across countries and over time, where each line here represents a different country abbreviated with 2 letters. So BE would be Belgium, DE, Germany. And left side is households, right side is firms. Just to give you a sense that it's important to look at different countries and different periods, because this is all quite volatile, especially firm credit over time, but also there are quite different patterns across these different countries, which we can exploit. Now, how do we then go about measuring our 2 main policy levers? First, monetary policy. This is quite traditional, at least traditional in the more recent sense, when unconventional monetary policy was employed. So we here built on the literature most recently shaped by Emi Nakamura and John Steinson in the AER paper to exploit high-frequency intraday data to extract monetary policy surprises. So those are truly exogenous shocks with high-frequency data. We are using a variation on that allows also to look over not just the short end, but also the long end of the yield curve as developed by my co-author with a bunch of other authors, which really is boils down to using the first principle component in a VAR model that extracts these monetary policy surprises. So this is very standard. And then the way we incorporate this in our empirical model is we make two additional steps. The first is that we aggregate individual monetary policy surprises that are around the time of an ECB announcement, which could be in the middle of the month. We basically accumulate those shocks over each 6-month interval to get to the monetary policy change that is exogenous over that period. That's again what Nakamura, Steinson, and others do in the literature. And to ease the interpretation, because we will have many interaction terms in our regression model, we invert the sign of the monetary policy shock so that higher values correspond with a softening of monetary policy. So when you interpret it, it's important to bear that in mind. So this is how these monetary policy surprises look like. And in particular, you see that over this time, while there was a general easing of policy through the lens of these shocks, there was quite some volatility with some also a few periods of tightening, in particular in the early 2013 period. There was some tightening, which actually many commentators have criticized later on. And then also in 2015 moving into 16. So then, of course, the more novel part to the paper is macroprudential policy. And here we exploit a new database developed at the ECB, very much in the spirit of a database that was developed at the IMF, of which my discussant is an expert. And this database covers country-specific macroprudential measures, both in terms of when they were adopted, and we'll have information on also whether they were adopted in a loosening or a tightening way, etc. And it covers really a large range of prudential measures, including some microprudential measures. And we focus here on the macroprudential policy measures. The way we construct then an index of the intensity of macroprudential policy is to take the 11 measures listed below that are considered macroprudential policies by the ECB's macroprudential framework, grouped around either being capital buffer measures, lending standard measures, or liquidity requirements. We simply look at what point in time they are in place, and if when they're put in place, are they put in place in a loosening fashion, then we add a value of 1. If they are being removed or there's a tightening, then we subtract a value of 1. This way we get a sense of a general macroprudential policy stance. We do that over the same period as for monetary policy, and then again, to ease interpretation, we invert the sign so that macroprudential policy index increases represent a softening of policy. Now, macroprudential policy measured this way suffers from endogeneity issues that are quite obvious. Macroprudential policy tends to react strongly to the economic and credit cycle. So we address this in several steps. First, we lag the macroprudential policy variable 1 period. And we also include controls that capture the influence of the economic and credit cycle, credit growth, GDP growth, and inflation. Of course, there may still be some remaining concerns around endogeneity, and that's why we go one step further, and we also have developed an instrument for macroprudential policy that is constructed on the basis of the transposition of EU directives in national law. For those of you who are not so familiar with this, is that most EU, so the EU sets out a number of directives. So this is guidance. These are not legislation, pieces of legislation. They become legislation in individual countries when those directives are transposed into national law, and countries have quite some leeway as to the exact nature of how they transpose it and the timing. And indeed, you see that some countries are quite slow and others faster for institutional, political, and other reasons. And it turns out that this way of measuring the speed with which countries adopt these EU guidelines, this is very much correlated to the speed with which countries introduce macroprudential policies. And in particular, when we focus on directives that in general terms are related to aspects of the financial sector. So the key exclusion restriction that would have to apply for this to make sense is that the timing of the transposition of these directives will not have a direct effect on credit extension in these economies, and in particular in our setup of individual borrowers. And we find it very hard to think of a particular channel which this would be not the case. So the Macroprudential Policy Index varies not so much over time. It does in some countries as measures are adopted, and that's simply because in some countries macroprudential policy even to this day has not been used very much, but in other countries like Latvia, Lithuania, but also Austria, where there have been housing booms, etc., many measures have been put in place. So there's a very strong cross-country cross-country variation in this measure, and some time series dimension that we exploit. And the general tendency has, of course, been an increase in the use until most recently. So then in terms of our empirical analysis, what we basically do is we run regressions of the following type. Our outcome variable of interest is credit, as I said, which we measure as the log of credit granted by a particular bank B to a particular household H or firm F at a particular point in time T. And then the two variables of interest are this cumulative monetary policy surprise, MP, or the macroprudential policy change over the previous periods. The shocks are also over the during this period, so they essentially also lagged relative to the measure of credit. The innovation here is to also consider interactions between these two policies and to basically estimate their effect jointly, including also a host of controls, GDP growth, inflation, and credit growth, as well as their interaction with monetary policy shocks. And the two tests that we are interested in is first, does a monetary policy easing increase credit? That is, the beta 1 coefficient should be positive, and whether more accommodative macroprudential environments reinforce this effect. So the beta 3 coefficient is also expected to then be positive. And then we progressively extend and expand this baseline model to consider various additional interactions to pick up additional channels. First, the well-known bank lending channel. So does this transmission of monetary policy depend on bank equity? The risk-taking channel, whether it depends on the risk of the borrower, and some notion of misallocation, whether it depends on productivity, TFP. This we can only do for firms. We have no way of measuring the productivity of households. The results are variations of the following table. These are the instrumental variable results. The part that I circled in red is the beta 3 coefficient on the various specifications, and indeed it is strongly positive and significantly so for households. And the second part of the panel shows the same for firms, where it's also significant. Here again, the instrument is the EU directives index. How to interpret the results? Well, this positive beta 3 means there is evidence of strong complementarities between the two policies. To give you a sense of the economic magnitude for households, the marginal effect of a 1 standard deviation easing of monetary policy on lending, conditional on being in a softer macroprudential environment of also 1 standard deviation, would be an additional loan growth of 3.1% for households and 6% for firms. These are very large effects if you bear in mind that over these 6-month intervals, typically growth rates are much smaller than that. Then in terms of the bank lending channel, we find strong evidence of the existence of a bank lending channel that interacts with macroprudential policy. So this complementarity between the two policies is indeed stronger for less capitalized banks. This means that if you have an easing of monetary policy and you are in an environment where the ex-ante macroprudential policy is also more accommodative, then lending is boosted more so for weakly capitalized banks. And again, the results are economically very substantial. Then on the risk-taking channel, here we also find strong evidence of the presence of a risk-taking channel. We capture this by including, in addition to having this interaction with equity, we now also include a dummy for whether the borrower has had non-payment problems with the bank in the past. So this is a measure of borrower risk from an ex-ante perspective. And there we also find that if you ease monetary policy in a accommodative macroprudential policy, then this additional lending from these weakly capitalized banks goes especially to the risky borrowers, which is evidence of a traditional risk-taking channel. So leverage of the bank and risk of the borrower interact in the expected direction, and these are again very large economic effects. Then the last part of the analysis asked the question, okay, so we found evidence of a risk-taking channel and a traditional bank lending channel. Is this all bad? Or is there also something to say about the allocation of these resources? And in particular, we asked the question whether higher risk-taking is only associated with pure credit risk behavior, so lending to non-performing borrowers, or also is this also going to more productive firms, better risk-taking? And we can do that because we have a lot of information on the firms. We can actually measure the productivity of each firm. We calculate firm level productivity the same way that Gita Gopinath did in the recent QGE paper, which is basically an extension of the Wooldridge well-known approach with a more sophisticated estimation method developed by Laeven on Petrin. What that gives us is a dummy variable that indicates whether the firm is productive or not. And when we include that as well in an interacted fashion into the regression, we find that yes, softer macroprudential policy interacts with softer monetary policy to increase lending overall, but it also does this in a way to push lending to go to more productive firms. So that's sort of the good part of the risk-taking. The effects are indeed similar or higher than the lending to high risk, credit risk firms. So there's definitely not only a bad, but also a good side to the risk-taking channel. Then final slide, we have many extensions. We can look at different types of loans. Generally speaking, for households, the results of risk-taking are stronger for consumer loans than for mortgages, which is somewhat to be expected since mortgage loans tend to be very well collateralized and are generally less risky than consumer loans. We also look at whether there are asymmetric effects over the cycle. So is it about monetary easing or monetary tightening? And indeed, results are stronger during episodes of monetary easing, especially the risk-taking results. We also look at different levels of the macroprudential policy index, we have 11 measures across 3 different categories. And it's generally the bank-based categories that are more important, especially capital measures such as countercyclical capital buffers, which is also not so surprising since those measures have been employed the most so far in Europe, at least. And then so far, what I showed you were results of macroprudential policy, where we really focus on the adoption of measures, because that's the cleanest. It's much more difficult to put a number on the intensity of the measure, but we have also made attempts to do that. And when we do that by basically adding up changes in existing measures to accumulate whether there is a loosening or tightening, we find also results that are very much in line with the ones I showed you. And with that, I conclude. What we do is we analyze the interaction of monetary and macroprudential policy, focusing on the impact on credit extension, using a really phenomenal data set of multiple credit registers across several European countries. We deal with endogeneity concerns that are really a problem in this literature by a combination of methods, including instrumental variables, and using monetary policy shocks rather than, let's say, interest rate changes. And what we find is that softening of monetary policy augments the well-known bank lending and risk-taking channels in a softer macroprudential environment. These effects are stronger for less capitalized banks, especially when they lend to riskier borrowers. These risk-taking results apply generally to both sectors. And when we zoom in on firms, we also find a bright side of risk-taking, which is that increased risk-taking of loose monetary policy, macroprudential policy mix actually ends up going to more productive firms. And this is also one of the first papers we know that considers also this more positive aspect of the risk-taking channel. Thank you very much for your attention.
Thank you very much, Luke. So the paper will be discussed by Lucyna and Gornicka from the IMF. So Lucyna, when you're ready, you can.
Yes, can you hear me well?
Yes, we hear you well.
Okay. Okay, let me just put full screen. So I hope that's all visible. Not sure. Okay, no, perhaps. Okay, so thank you very much for this, inviting me for discussion of this very interesting paper. Yeah, let me just start with saying that I enjoyed reading the, the paper very much. It's very policy relevant work with a very rich set of results. And let me start with a very brief discussion of the main findings, since Luke finished with a nice overview of those. So the paper uses a new firm bank loan level data that has become recently available through a new database collected by the ECB called AnaCredit. They use this data for 12 euro area countries in order to investigate whether the effectiveness of monetary policy in affecting bank credit depends on the macroprudential policy, or MAP in short, environment. So they're really interested in these complementarities, interactions between monetary and macroprudential policies. So the key finding is that monetary easing shock increases lending more if it's preceded by easier macroprudential policy stance. And this complementary effect is actually stronger for expansionary policy monetary shocks than for tightening shocks, for riskier borrowers, for less capitalized banks, and what I find a bit surprising, actually, and interesting, for consumer and corporate loans rather than for mortgage loans. and finally for more productive firms than for less productive ones. The key two variables of interest are macroprudential policy stance, which they measure by two indices. So one is basically summing events of activations of removals of tools across 10 macroprudential policy categories. So this index does not really capture if already existing tool has been tightened or eased, as far as I understand. And the second index does take into account also these policy changes of already existing tools. Those tools are constructed using the ECB macroprudential database, and as I understand, they should reflect the overall tightness of the macroprudential policy stance, but really in the presence of the country fixed effects that are in most regressions, changes in the index are very important for the identification of the effects. Monetary policy shocks, the second key variable of interest, are constructed through high-frequency identification, as in Altavilla and co-authors paper. And finally, the loan-level data that they use is available on biannual frequency between second half of 2012 and 2017, second half, which gives us around, I think, 11 time observations. So my first main comment regards the construction of the macroprudential policy indices, which I think raises some questions about the interpretation of the results. So how the authors construct the macroprudential policy indicator is by summing events, activations, or changes in macroprudential policies across different categories of these tools. However, as we know, different types of macroprudential policies very often differ from each other a lot. They are designed to target different sources of risks. Their scope and type of borrowers vary from tool to tool a lot sometimes. And this matter, for example, in the case of sectoral versus broad-based macroprudential tools. So sectoral tools, they target borrowers only in one sector. For example, households borrowing through changes in the borrower-based limits, such as loan-to-value ratio or DSTI limits. On the contrary, broad-based tools in general should not discriminate between types of borrowers. An example could be countercyclical capital buffer. So the problem that emerges here is that when you try to put these different tools together, is that for some of these tools, you might actually expect different effects on lending than for the others. And point in case is these sectoral tools. And there is already a literature on that actually cited in the paper that shows that sector-specific macroprudential tools can actually lead to leakage effects. So tightening of macroprudential tool in one sector can actually increase lending to other sectors by banks. And this effect actually goes in the opposite direction than what is found what is found in general for the aggregate index in the paper. For example, an example could be here, the corporate credit in response to tightening of these household-specific tools. The second important distinction is between structural versus cyclical macroprudential tools. As many of the policy actions in the sample reflect one-time tightening of capital buffers implemented as a result of Basel III reforms. So here, I mean, for example, the capital conservation buffer or buffers for systemically important institutions. So these changes are in general seen as one-time adjustments that in the long term should not be really used to smooth the business or credit cycle unless a big shock hits. And they tend to have long phase-in periods. So I think the authors could think a bit more how to treat these different types of macroprudential tools, as I would expect that the effect on lending could be different for these structural macroprudential tools than for more cyclical measures. So in sum, a suggestion would be to focus on a more restrictive set of maps that share the same characteristics, are better understood, And this is partially done in the updated version. An alternative solution could be to just use a simpler macroprudential stance index. And this has been done in very recent papers by Bergant and Forbes or Chari and co-authors, where they just really look at three main measures of macroprudential tools. Let's say countercyclical capital buffer, LTV limits, and a measure of macropru in the FX. And they measure actually the levels of these three indicators and arrive to a macroprudential stance index that actually captures the actual stance, the intensity of these policies. The second main comment is that the identification of effects of macroprudential policies seems to come primarily from tightenings. So the paper considers asymmetric effects, but those are limited to monetary policy. So there is an extension where monetary policy easings and tightenings enter separately the regression. But for macroprudential policies, the implicit assumption is that tightenings and easings have symmetric effects. However, in the sample, tightenings dominate easings by a large margin. So I didn't look at the ECB database. I looked at our own IMAP database that Luke mentioned. I assumed that they should show the same things. And when I look at the number of easings and tightenings across 17 different categories of macroprudential tools for the countries in the sample and the period, I see only 7 net easing actions versus 97 tightening ones. So then the question is, of course, whether these interactions of monetary policy shocks could be different for interactions with tightenings of macropru versus easings. And I think there could be examples of channels through which that indeed could be the case. So for example, you can think of signaling effects from monetary and macroprudential policies that are aligned, so go in the same direction, versus different signals, for example, about the situation, the economy, the level of risks, when the two policies go in the opposite directions. Empirically, actually, there is also some evidence that, for example, effects of macroprudential tightenings tends to be stronger on credit growth, on house price growth, than the effect of easings. So there is a paper, a metadata analysis of over 60 papers on macropru policies by Araujo and co-authors. And similarly, Cerruti and co-authors find that macroprudential policies are less effective during busts, so in periods when they're more likely to be actually eased. So here the suggestion would be to consider asymmetric effects of easier and tighter macroprudential policy stance separately, or focus on tightenings only. The final third main comment is that the impact of monetary and macroprudential policy actions likely depends on the tightness of financial frictions. So there is a very broad literature, both theoretical and empirical, documenting how the effectiveness of policies can change depending on whether borrowing constraints bind or not, including by Anton. And in general, this literature finds that policies tend to be stronger, more effective when these borrowing or liquidity constraints bind. So given the high granularity of the data that the authors have access to, I think it's a perfect setup for actually exploring these state dependence to a larger extent. So one way would be to simply control for the bindness of borrowing or liquidity constraints by adding time times borrower fixed effects. But an interesting thing would be to actually add interactions of these, of some measures of liquidity constraints, borrowing constraints with policy measures. And an example of such measure could be the Gilchrist and Zakreisek internal liquidity measure, or something else used in the literature. I know I'm running out of time, so let me finish with these slides. Basically, what I think the authors could spend a bit more time on is to explain a bit better the timing and size of the policy actions. In particular, the timing of monetary policy shocks is not really clear. It enters the variable of monetary policy shocks enters regressions with subscript T, so in current period. but then the text states that the monetary policy variable is lagged. So this matters because if monetary policy is not lagged, then the question arises whether some of the loans originated in the given 6-month period were actually granted before the monetary policy shock materialized. If the monetary policy is lagged by 6 months, then we have identification issue with macroprudential policy changes, because macroprudential policy changes could react to monetary policy actions in this case. Finally, the magnitude of the effects could be put a bit in perspective. For example, the standard deviations that are used to compute the size of the effects are those based on the estimation sample or the longer sample? How large are monetary policy shocks in the sample period relative, for example, to the pre-zero lower bound episode? Are the effects of monetary policy shocks on credit comparable to other studies? For example, the ones that look at monetary policy shocks at higher frequency. So let me stop here, and I will pass these slides with some other comments directly to look. And let me finish with saying that I enjoyed reading the paper a lot. Thank you.
Thank you, Lucyna. So we are really running out of time, but Luke, I'll give you, if you can be very brief on commenting on the comments suggested by Lucyna, you can have a minute or two to just address.
So, Lucy, thanks a lot for reading the paper so carefully, and also we were working on some changes, so you were very flexible in allowing me to send you some updates even as recent as yesterday. So thanks for that. I think all the points you make show that you're interested in the topic and have a good sense of what else we can still do. The good thing is much of what you talked about is we basically have now already done, or we can very easily do. So this will be just making the paper better. We will definitely do all of this. Thanks so much.
Okay, so thanks again to Luke and Lucyna. So let's move on to the last paper in the session. So that's by Edla Getz, and she's going to talk about mortgage regulation, financial vulnerability at the household level. The floor is yours, Ella, and you can upload your slides.
Great, thank you. So let me know if there's a problem with the slides or the sound. So thanks a lot. The title of the paper is Mortgage Regulation and Financial Vulnerability at the Household Level. And this is joint work with the chair, Knut, and also with Ragnar Julsrud at the Norwegian Central Bank. So in this paper, we look at borrower-based macroprudential policy, specifically in the form of loan-to-value or LTV regulation. And we start by asking the question, how does LTV regulation affect credit volumes and prices? And then we move on to, I guess, what we consider the main part of the paper, which is how does LTV regulation affect household balance sheets and financial vulnerability? So to get at these questions, we look at the introduction and then the subsequent tightening of LTV requirements in Norway. To do that, we use Norwegian administrative tax data on all households, and that's merged with data on house purchases from the land registry. We then do a bunching analysis to investigate both the intensive and the extensive margin of credit. The intensive margin being then some mortgages end up having a lower LTV ratio due to the regulation, and the extensive margin being some mortgages actually being eliminated from the market due to the regulation. In terms of household balance sheets and financial vulnerability, what we do is that we compare affected households pre and post regulation. And I'll be more specific by what I mean with affected households, but basically it's going to be households that have a high predicted LTV ratio. We then focus on leverage versus liquidity effects. So not surprisingly, or you would expect LTV regulation to have some positive effects on leverage, but there might also be important liquidity effects. So for instance, you could imagine households reducing debt burdens, and that leading to lower interest expenses, which could improve the liquidity situation. But then you could also imagine households having to deplete more of their liquid assets in order to buy a given home once the regulation is in place. And so that might lead to a negative impact on liquidity as well. So motivated by existing literature that highlights a link between liquidity and the sensitivity of household demand to income fluctuations, we also look at how affected households respond to income shocks in the form of unemployment. So let me just then briefly go through some of our main findings before I get more into the details. So we find that credit is impacted both through the intensive and the extensive margin, but the reduction in aggregate credit growth, that's mainly due to an extensive margin effect. The reason being both that in our case, the extensive margin is larger, but also that the extensive margin is more effective in reducing aggregate credit growth, because then there's a new mortgage that is not taken up versus just the new mortgage having a slightly lower debt ratio. In terms of price effects, I'm not going to focus much on that in this presentation due to time constraints, but we do see an increase in interest rates for high LTV mortgages. And this does not seem to be fully driven by differential selection into having a high LTV mortgage after the regulation. So there does seem to be some price effects as well. In terms of household balance sheets and financial vulnerability, we see, not surprisingly, that affected households, they do reduce leverage, but then we also see that they deplete liquid assets to a larger extent. And the main liquid assets in our sample, that's going to be bank deposits. And so what we see is a significant reduction in bank deposits, relatively speaking. Moreover, this negative liquidity effect seems to be quite persistent. And so when we look at how these affected households respond to unemployment for those that become unemployed, we see that households that are affected by the regulation are more likely to liquidate their housing wealth upon unemployment. So as I mentioned, we use administrative tax data from Statistics Norway. That gives us balance sheet information and income statement variables. This data set is merged with housing transaction data from the land registry. And the main variable we get from that piece of the data set is the transaction price of the house, which we use to calculate LTV ratios. We aggregate all the data to the household level, and we follow much of the literature in excluding the household if the household head is self-employed. So following the financial crisis, several policy measures were implemented in Norway, as in most countries. And so in March 2010, an LTV cap of 90% was introduced into guidelines. And then in December the following year, this LTV cap was tightened from 90% to 85%. Now, these were only guidelines, and also within the guidelines, banks were allowed to deviate from these caps if they could document an extraordinary risk assessment. So there was some room to sort of give high LTV mortgages still. And then less important for this presentation here, but in June 2015, these guidelines were then formalized into regulation. So going then to the first question, how does LTV regulation affect credit volumes and prices? So we do a bunching analysis where we use the time series dimension of our data to construct counterfactual LTV distributions in reform years. So we follow here DeFusco, Johnson, and Mondragon, although they have cross-sectional variation, which they can use to construct their counterfactual distributions. We rely instead on the time series dimension. And so we use the change in LTV distributions from previous years to predict the change in distributions in reform years. And I'm going to be a bit sparse here on the details and the bunching analysis, but basically once you have the counterfactual and the actual LTV distributions, then everything else sort of follows from that. So then we can define, a bit loosely speaking, the intensive margin as the share of high LTV loans or mortgages that would have had the high LTV ratio in absence of the regulation, and that now bunch at sort of around the LTV cap. So they have an LTV ratio at or slightly below the cap. So these are mortgages that sort of shift to the left in the distribution. And then we can define, again, a bit loosely speaking, the extensive margin as the share of high LTV loans or mortgages that would have had a high LTV ratio in absence of the regulation that quote unquote disappear. So these are mortgages that are sort of just eliminated from the market. So I just wanted to show you an example here of what the counterfactual distribution can look like. So this is in 2012, and we see the actual distribution here in blue. And then in pink, we see the counterfactual distribution that we have constructed. And so you see that you have a lot more high LTV mortgages here in the counterfactual distribution. And then in the actual distribution, you see some bunching here just below the regulatory cap. And so when you have the actual and the counterfactual distributions, then we use those to quantify these intensive and extensive margin effects. So we find that 3 to 4% of high LTV loans reduce LTV ratios in response to the regulation. So that's the intensive margin effect, relatively modest in our case. And then we also find the relatively modest impact on the extensive margin after the initial LTV cap. But then we find a quite sizable impact on the extensive margin after the subsequent LTV tightening, so going from 90 to 85%. So in this case, 25% of these high LTV mortgages are actually disappeared from the market. And so, especially due to this large extensive margin effect, this is quite effective in reducing aggregate credit growth. So in order to get at the aggregate credit growth effect, we need some more assumptions, but given the structural assumptions that we make then in the paper, we find that aggregate credit growth is probably reduced by 20% due to the regulation. In terms of price effects, we do see that high LTV mortgages face higher interest rates after the regulation. This seems to be robust to controlling for demographics, income, and wealth. And so we don't think that this is at least fully driven by differential selection into having a high LTV mortgage after the regulation is in place. So there does seem to be some price effects as well. So then moving on to the second part of the paper, how does LTV regulation affect household balance sheets and financial vulnerability? So in order to think about this, we need to know who are affected by stricter LTV caps, or in other words, we need a treatment indicator. So here we follow Van Beckham, Gabaro, Irani, and Peydro, and we predict LTV ratios. So what we do specifically then is that we regress LTV ratios on demographics, income, wealth, zip code, and household type, based on pre-reform data. And this gives us a predicted LTV ratio that we call LTV hat. And we define a dummy variable LTV hat high, which is equal to 1 if the predicted LTV ratio is above the regulatory cap. Now we can test how this measure does in non-reform years, and the performance is okay. But there's definitely some non-trivial measurement error. That's just something to keep in mind, that it's most likely to attenuate our estimated effects. We then estimate this equation at the bottom of the slide, where we interact our treatment indicator, LTV hat high, with this dummy variable I post, which is 1 after the regulation. On the left-hand side there, we have LTV ratios, non-student debt, which is what we observe, interest expenses, house purchase prices, and bank deposits for a household I in year T. And then the coefficient of interest here is, of course, beta. So I'm not going to dwell much here on the quantitative takeaways, but we do see that affected households, they have a reduction in LTV ratios. They take up lower debt when they buy a house. This leads to lower interest expenses. We also see that they purchase slightly cheaper housing, and we see a significant reduction in bank deposits in column 5. So that's our measure of liquid assets. So to sum up then, after the requirement, households that have high predicted LTV ratios, they now have lower observed LTV ratios, they have lower non-student debt, they have lower interest expenses, but then they also have lower bank deposits. So in order to sort of understand how important this negative impact on liquidity is, we want to know how persistent it is. And to get at the persistence, we use an event study setup. So we estimate this equation here, having bank deposits on our left-hand side, individual and time fixed effects. And then we have these dummy variables IK, which capture the years leading up to and the years following a house purchase. We estimate this equation here for individuals that have high predicted LTV ratios. And we do this separately prior to, and following the regulation. So these are the results. In blue, that's households that purchase a house prior to the regulation. And in red, that's households that purchase a house after the regulation. And everything here is normalized to 0 4 years prior to the house purchase. And the house purchase takes place at time 0. So what you can see here is that just prior to the house purchase, there's an increase in liquid savings. That's sort of reversed as the transaction takes place. And then for those that buy prior to the regulation, there's no significant impact on bank deposits after the purchase has taken place. For those that buy following the regulation, on the other hand, we see that bank deposits is significantly lower in the post period, both relative to the pre-period and relative to these buyers that buy prior to the regulation. So there seems to be a quite persistent effect here on bank deposits. So the red line doesn't really revert back, at least within this time period here. So what we have then is that the LTV requirement seems to be reducing household debt burdens, which we think is good for financial vulnerability. But it also reduces liquid assets, which we think might be more problematic. And this effect seems to be quite persistent as well. So we know from previous or from existing literature that lower liquidity may make household demand more sensitive to fluctuations in income. And so motivated by this, we investigate how affected households respond to income shocks in the form of unemployment. So basically what we do then is that we compare households who purchased a house right before and right after the regulation, and who then experience an unemployment spell. And we see how they react to that. So we focus on responses or outcomes related to pecuniary and to demand externalities. So we look at the likelihood of selling your house when you become unemployed, and we look at imputed consumption. So we don't observe consumption, of course, in the tax data, but we can impute it using sort of a balance sheet constraint. That gives us sort of a noisy measure of consumption at the individual level, but at least it's something that sort of captures household demand. So these are the results. So there's 2 different specifications here, but it doesn't matter that much which one you look at. So in columns 1 and 2, we see that those who purchased their house following the regulation and who then experience unemployment, they're more likely to sell their house as they become unemployed. So these effects here are in percentage points and are actually, they're quite large compared to the pretty low propensity to sell your house. And then we see no significant effect on bank deposits in columns 3 and 4, and basically no significant impact on imputed consumption in columns 5 and 6. So one interpretation of this, at least, is that, these affected households, they're pretty good, or they're equally good at smoothing consumption as those that are not affected by the regulation, even though they have less liquid assets. But they do this by liquidating their illiquid housing wealth. And that might be perfectly unproblematic for the individual household, but there could be some more worrisome macro effects in a recession period, for instance, if a lot of households experience job loss at the same time. So to summarize then, we see that LTV regulation dampens aggregate credit growth, mainly through the extensive margin channel. And then I haven't really gotten into the distributional impacts in this talk. We have something on it in the paper. And we do see that the households that are more likely to be affected by this regulation, they're younger, they have lower income, they're more likely to be first-time buyers. So when we want to think about sort of the net welfare effects of these types of regulations, there's definitely some important distributional impacts that should be part of that welfare calculation. We also see that households respond by reducing leverage, which is not surprising, but also that they, relatively speaking, to a larger extent, they deplete liquid savings, and that this negative effect on liquidity seems to be quite persistent. Finally, it seems like affected households who become unemployed are somewhat more likely to sell their house upon unemployment. And, this could have some potential implications for house price movements, and thereby for household demand as well during recession periods. So if many people lose their job at the same time, and they have this increased propensity to want to liquidate their house. So in the paper, we point out these different effects that sort of go in opposite directions. And so for now, I'll just conclude here by saying that based on this, we think that the net effect on financial vulnerability from these types of regulations might be somewhat unclear. Thank you.
Thank you, Ella. So the discussant is Stephanie Johnson from Rice University. So Stephanie, you can share your slides.
Okay. I hope you can see my slides. So thanks very much for inviting me to discuss this paper. So this paper broadly has 3 sections. So they study the effect of LTV restrictions in Norway. First, they look at quantity effects, so this intensive and extensive margin response that Ella was talking about. Then they look at the effect on interest rates, and finally the effect on household balance sheets. My overall impression of the paper is that they have a really impressive data set. In particular, they're actually able to look at this household balance sheet effect, which is difficult for a lot of other researchers. And overall, I think that this third topic really plays to the strengths of the data set, much more so than questions 1 and 2, where I feel like, maybe a standard mortgage data set would be better able to answer these questions than the data set they have. And so in general, I think my advice is to, emphasize question 3 perhaps even more than they already do. And then potentially to go and look for, some type of other data set, like a mortgage data set that could be used to answer questions 1 and 2 in a cleaner way. So in terms of the contribution, the quantity and price response analysis is pretty similar to what we did in our paper, except obviously this is a different policy, and so there is a marginal contribution there. The issue with this analysis, which I'll get into more detail about later, is that actually only total debt is observed, not mortgage debt specifically, and they also only see total interest expenses, not the mortgage interest rate. And then on top of that, there's also no obvious control group, which makes it a little bit more difficult to do this analysis. In terms of the effect on household balance sheets, there is another similar paper that looks at an LTV policy in the Netherlands. The contribution there, I think, is that the setting here is a little bit more standard. So in the Dutch paper, my impression is that you know, a lot of high wealth, high income households had high LTV ratios for tax reasons. And so when you look at this group that is constrained by an LTV limit, the responses are, you know, potentially a bit unusual, like people don't actually buy cheaper houses in response, possibly because these are people who have a lot of other assets and they only have high LTVs for tax reasons. Whereas in this paper, things seem a bit more standard, and so perhaps this will be more broadly applicable in terms of the results. So my first comment is just in general that it would be useful to know a few more details about the policy. So I think the authors were very clear in describing, you know, that this was not a hard LTV requirement. So, you know, it would be possible to originate a loan with an LTV above the limit if there existed additional collateral or if the bank had undertaken an extraordinary risk assessment. And so what I wanted to know is, you know, what are examples of this additional collateral and what does the extraordinary risk assessment involve? You know, this could affect the interpretation of the results. You know, for instance, you know, is the extraordinary risk assessment something that can in principle be conducted for everyone? It's just that it's costly to do so, and that could be, you know, accounted for in a higher interest rate. Or is it that there are only certain households who will, you know, successfully be able to qualify under this extraordinary risk assessment? In general, how did lenders view these exceptions? You know, were they willing to undertake this risk assessment for a large number of borrowers, or were they just not interested in considering this as an option at all? And how were these requirements enforced? And relating to the unemployment analysis, I thought perhaps some details about how unemployment insurance works in Norway would also be useful for understanding what, you know, households' needs are to access these assets. So to say something about the quantity effect, Ella didn't go into too much detail about this, but basically what it involves is there is some, you have sort of two kind of thresholds, a lower threshold where below that you assume that there aren't people sort of moving down. So the loans that you observe are the loans that you would have observed if the policy hadn't been in place. And so that's what this capital N is here in the denominator. And then you use that as a base to compute these bin shares. So the little n's in the numerator are the number of loans in a particular DTI bin in our case, or LTV bin in this case. And the hats are the counterfactuals. So if the policy hadn't been in place. And so the way that you would compute this in our case would be to use the previous bin shares, and then add to that this adjustment, which is if you have some kind of control group, you can compute the change post minus pre for the control group. In this paper, they're sort of forced to take a different approach because they don't have a natural control group. And so instead, they add the difference between the previous 2 years to come up with what the counterfactual bin share would be. And then the second difference is that they don't observe LTV directly. Instead, they're forced to back it out from total non-student debt. And so I think sort of what this timeshare assumption means is that if, for example, loans with an LTV of 80% were 5% of loans below this lower cutoff at T-2 and 6% at T-1, then without the policy, they would have been 7%. at time t, which I think, could possibly be quite reasonable if you expect there's some kind of momentum. But then do we expect this bin share to be 10% of loans below the cutoff at t+3, kind of extending it linearly? I'm not sure if I think I'm interpreting it the right way, but I'm not sure. So, but the way I'm interpreting it, I think that would sort of be the prediction there. And so my sense is that this approach could work quite well for the first policy. But when they use it for the second policy, they're kind of forced to use the change between 2008 and 2009, so 3 years earlier, to construct the counterfactual, because the change between 2010 and 2011 is affected by the first policy. And then on top of this, the LTV distribution has kind of fundamentally changed shape in 2011 due to the 2010 change. And so I'm not sure whether using this 2008 to 2009 change as a counterfactual really makes sense. They show a lot of placebo tests, which I think is really useful for thinking about the 2010 change, but not as applicable for the 2012 change. In terms of ways to try to address this beyond, looking for, one possibility is if the LTV distribution doesn't actually move very much over time, it may be okay to just use the previous year's share as a counterfactual. It's possible that that could be better than using this linear time trend. And then secondly, that, unlike our paper, in this paper, they're actually able to look directly at effects on home purchases, which also tells you something about the extensive margin effect. And so just sort of trying to compare the results on the home purchase probabilities with the extensive margin effect in the quantity analysis section, it looks like the extensive margin response is like 5 times as big between 2010 and 2012, so it's a lot bigger. But then when you look at these purchase probability effects, it seems like it's definitely bigger, but it's maybe not that much bigger. I'm not sure if I'm thinking about this the right way, but it's possible that you can use this other analysis to complement the quantity analysis. And then finally, the measurement error that you have in LTV, I think this could really be a problem, but I'm not exactly sure, how it works. So I was thinking maybe you could use a simulation or something to try to understand how the measurement error affects the quantity estimates. So one thing I thought about is, with the adjustment that you do, I think even if hypothetically all the loans above the cutoff were eliminated, you would still have some loans that appear to be above the cutoff based on your imputed measure. And so it would not be possible for you to identify that in fact all the loans had disappeared. I'm sure there's other things going on as well. So it would be interesting to think more about that. And then just to comment on the aggregate quantity effect. So you don't use all the households and then you scale up to get an aggregate effect. But I think, in terms of how you scale up, the effects are probably very different for each of these excluded subgroups. So I can imagine that the effect for households with a low LTV is actually quite different and maybe not particularly large. So you might want to consider breaking it out by each of these subgroups and possibly using different assumptions. Regarding the price effect, I think there are maybe some selection concerns coming from the measurement error in the LTV. So for instance, if lenders hypothetically eliminated all loans above this soft cutoff, then any household that has an imputed LTV left above the cutoff must have above average holdings of unsecured debt, according to the way you impute LTV. And so we'd expect that debt would have a higher interest rate than mortgage debt, And so rates would appear to jump at the cutoff. And these borrowers could also be riskier in other ways because they have the higher level of unsecured debt. And unfortunately, I think the placebo test can address this because the selection is directly a result of the regulation. And so it's hard to think about that using data from other years prior to the policy change. I think the liquid assets analysis, like I said before, is really the most interesting part of the paper. And the effect here isn't obvious. It could be the households, just reduce their housing demand and hold the down payment fixed. This would lead to a lower cost of housing services, and maybe, they would end up accumulating, more savings because of that. Or people might keep renting a property when they, ideally wanted to maybe move to a house, but then they don't bother moving to a bigger rented property because, they're waiting until they accumulate enough assets to buy. So the policy could affect liquid assets, even for people who don't purchase a property. So you might want to look at that as well. And then, yes, I think one of the most interesting things is to understand why the liquid asset effect is permanent in this paper, but transitory in the other paper. I think that's an interesting result, and it would be useful to think more about that. You had some, I think, good ideas in the paper. One other idea is that in your paper, households buy cheaper properties as well as rundown assets, but that doesn't happen in the other paper. And so it's possible that people have a rule of thumb where their liquid asset balance reflects their kind of typical monthly expenses. And so in your case, since those are lower, perhaps that's why they end up maintaining this lower level of liquid assets afterwards. I'll skip this comment because there's only a couple of minutes left. And so in conclusion, I think this is a really interesting paper, particularly the analysis about household balance sheets, which is really well suited to this data set. For the quantity and price analysis, I think there are some issues, but perhaps there is a way to get around some of these by using a different data set. I'm not sure. Anyway, thanks very much.
Okay, thank you, Stephanie. So we're also running out of time, but Ella, you want to have a minute or two to just address the comments by Stephanie?
Yes, thanks. And thank you so much for a really, really interesting and useful discussion. There were so many suggestions there that I think we will try and incorporate all of them, basically. With just 1 or 2 minutes, it's hard to sort of answer to give a good answer to that. But just to take one comment that you had, which is something we're working on now in terms of what is this additional collateral that households may have access to. I think the most important component there is probably parental housing wealth. So I don't know how common this is in general, but in Norway, parents helping young first-time buyers into the housing market is really common. And so we didn't have parent-child links in the original data set, but now we have a new version of the data set where we can observe parent and child households. And so we see that, when these young first-time buyers buy their first house, there's a large increase in debt. But we see that the increase in debt for parents is actually really large as well. And it's 15% of the total debt increase. So we think that understanding how these links between child and parent households interact in the housing market, that's going to be pretty important. And hopefully, I think more of a new contribution as well. And then I think you're completely right that we should focus more on the household balance sheet part, which I think is definitely the direction we're going. So thanks a lot. That was a super useful discussion.
Okay, so I guess this concludes the session on macroeconomic effects of macroprudential policy sponsored by Norges Bank. I would like to thank all the speakers and discussants and also all of the other attendees, and and enjoy the rest of the conference. And thanks a lot.